The price of a stock will follow the direction of earnings. In almost every case, you can generally state that if a company's earnings go up sharply, the stock's going to go up. If earnings go from very poor to mediocre, the stock's probably going to rise. If they go from mediocre to good, it's probably going to have another rise. If it goes from good to excellent, it's probably going to have another rise. Or if a company's earnings grow dramatically over a long period of time, the stock's probably going to go up dramatically.
स्टॉक मार्केट रिलेटेड इंटरव्यू वीडियो पाने के लिए मेरे चैनल को सब्सक्राइब करें और बेल आइकन को दबा दें.
Even if you have a Waterford crystal ball, you probably can't predict a company's earnings. But Wall Street is a whole army of people who make such predictions. By computer, you can get Wall Street earnings estimates in the research section of the stock shop or through many other online services. Or you can go to your local library and find earnings estimates in Value Line or Standard & Poor's. Obviously, you want to invest in companies whose earnings are expected to rise. But again, these are just estimates. If you really understand a company, you should know how it plans to make earnings rise. If you know it has good growth prospects, then you'll be better able to evaluate the company as an investment. You can't predict the future, but you can learn from the past. A company with a long history of earnings increases and dividend increases is obviously a stable performer that has a reasonable chance of continuing to perform well in the industry. Many times that's a good company to investigate further. Johnson & Johnson has raised its earnings something like 19 of the last 20 years. It's raised its dividend over 30 years in a row. But just because a company has had a great record in the past does not mean earnings will grow terrifically well in the future. You have to have reasons for it. Strong growth in research and development, cost-cutting, new products, great brand name, and a terrific balance sheet were the items that made me optimistic about Johnson & Johnson. And what's the outlook? It's going to keep continuing to grow. If they run out of steam, stock's going to run out of steam.
Price-earnings ratio is something that some people make very complex. It's actually very simple. If a company is selling at $100 a share and they're earning $10, it is a price-earnings multiple of 10. The PE ratio can be thought of as the number of years it will take the company to earn back the amount of your initial investment, assuming, of course, that the company's earnings stay constant.
Why look at PE? It can tell you if you're paying too much for a stock. The higher the PE, the more expensive the stock relative to the company's future earning power. The lower the PE, the cheaper the stock. I use a rule of thumb to level out these differences. A fairly priced stock is a PE that's about equal to the expected annual growth rate over the next 3 to 5 years. If the PE is substantially higher than the growth rate, the stock is normally expensive. If the PE is substantially lower, the stock is probably cheap. A stock PE, in part, depends on the industry that it's in. When you look at a growth company, compare the company's growth rate and its own PE to that of the industry. All other things being equal, if you find a company with a much lower PE and a higher growth rate, you're off to a good start. You can also compare a company's PE to its own historical PE. If a company normally sells for 25 times earnings, and now it's selling at 15 or less, you have to ask yourself why. The company could be maturing, competition may be entering the field, and its growth prospects may be uncertain. But maybe it's simply been beaten down by some other factors, and it's possibly a bargain. It's worth researching. Back in the 1970s, Electronic Data Systems, or EDS, had a PE of 500 times earnings. If you had invested in a company with a PE this high when Columbus discovered America, and the company's earnings stayed constant, you'd just be breaking even today. In 1974, EDS performed very well, but its stock fell from 40 to 3, simply because the stock was so grossly overpriced relative to current earnings. Dividends are cash payments that companies make to shareholders, usually every quarter. Nearly half the return in the S&P 500 the past 50 years has come from dividends.
Dividends come from profits. If a company earns $5 a share, they have the choice of paying out some of it to the shareholders in the form of a cash dividend.
A stock's yield is the annual dividend payout divided by its current price. The yield is the return you get on your investment every year.
One drawback: the IRS considers dividends as income, so you have to pay taxes on dividends. Not all companies pay a dividend. Fast growers, for example, almost never pay a dividend. They reinvest all of their earnings back into the company. Slow growers tend to pay out profits and dividends. It's their way of rewarding shareholders. Over time, those dividends can add up.
Some people have bought stocks for $5 a share, and 20 years later, they're getting $10 a share of dividends per year. Dividends do make a difference. Dividends are a great way to measure a company's success, particularly a slow-growing company. When a company raises its dividend every year, it raises the bar for its financial performance the years that follow. Few companies want to cut their dividends. Investors clobber the stock, figuring a dividend cut is a sign of worse things to come. So by raising a dividend 12 to 15% this year, the company is saying it expects earnings to be at least as good next year as they are now, and probably rising by at least the 12 to 15%. You can get a list of companies that have raised their dividends many years in a row from Moody's. There are some great names in this list. However, you can find warning signs of dividends as well.
A high yield isn't always a good thing. If a stock is 30 and it's paying a $3 dividend, you might say, wow, that's terrific, a 10% yield. But if the earnings are only $3.10 a share, then the company is essentially paying out all of its earnings in dividends. That's only 10 cents to expand or to invest in more efficient equipment. If this continues for a number of quarters or years, the company will have very little room for any errors or setbacks. Eventually, the company will probably cut back or totally suspend its dividend. The stock price is going to tumble with it. Be careful with high-yield stocks, particularly when they're paying out a very high percentage of their earnings. Any company's operations can hit an air pocket from time to time. You've got to make sure your company can survive tough times.
The balance sheet tells you about the company's financial structure, how much debt it has, how much cash it has, and how much equity its shareholders have. There's nothing scary about a balance sheet.
No story is complete without a check of the balance sheet. The basic concept of a balance sheet is that everything a company owns, its assets, are listed on one side. On the other side, you find everything a company owes, its liabilities. The difference between what it owns and what it owes is its equity, also called its net worth. Go ahead and explore this fictional balance sheet. Click any of the items on this balance sheet for an explanation of it. When you're ready to move on, click either the debt or cash buttons for a discussion of the two most important items on any balance sheet.
Does the company have a lot of cash on hand? That's great. A company with a lot of cash can buy more stock, make an acquisition, or pay off all its debt. All moves that shareholders love to see.
A company should have at least enough cash to pay off its short-term debt. If it doesn't, it could have to keep borrowing more and more. If you subtract cash from short-term debt and long-term debt, and the total is only 1/4 of net worth, the company has a decent balance sheet. However, if short-term debt and long-term debt combined, minus cash, equals or exceeds net worth, the company has a weak balance sheet. It's simple to recognize a strong balance sheet. No debt and lots of cash.
Suppose a company has $20 million in cash after subtracting all debt. If the company has 4 million shares outstanding, it has $5 of cash per share of stock. If you buy the company at $10 a share, you're paying only $5 for the company and you're getting $5 a share in cash. That's a really amazing price. In effect, that means your real price is $5. If this company has a very solid, predictable business, this extra cash is quite valuable. But if a company has lots of cash and they're losing money, you still have to evaluate how quickly will they run through all that cash. That's all you really have to know. It's not much, but you should know it. You can look it up in the stock shop. If you don't check your company's survivability, you're not only skimping on your research, you're gambling. That's not why you invest in the stock market. Check the debt. Most companies have some debt, but how much is too much?
Add up the company's long-term debt and total equity. That's a good approximation of the company's total capitalization, the money the company has available to grow its business in the future. Now compare the long-term debt to total capitalization.
If total debt equals half of the company's capitalization or more, beware. That's quite a bit of debt. To service that much debt, everything has to work right. Things don't always work just right.
If debt equals 20% of capitalization or less, that's better. That's fairly low debt. As usual, there is no rule without some exception. Debt in some industries, like banking, insurance, and financial services, routinely runs much higher than 20 to 50%. Know the industry and what is normal for it when you evaluate a balance sheet.
In many industries, such as retailing and restaurants, companies have leases. They have commitments on buildings to rent for a long period of time. Often, this form of debt will only appear in the footnotes. This is a very substantial form of debt. Look into the footnotes. See if you see capitalized lease obligations. Add this back. This is an important exercise.
5 or 10 years ago, investment professionals had a big edge. They got more research and information than small investors, and they got it sooner. But those days are long gone. Basic financial information is readily available from a dozen or more different sources. Investment pros aren't digesting all the good information and throwing just the scraps to the public anymore. Everyone has a seat at the table right now. Here are some places to get started. If a balance sheet provides a snapshot of a company's financial position, an income statement tells you how the company got there. Income statements tell you how much money the company made or lost from its operations over some period of time. The basic formula is simple. You are asking how things went over the period, usually a quarter or a year. Over that time, you add up all the money the company brought in from selling products or services, then subtract all of the money the company spent to create those products or deliver those services. What is left is the net income. Net income is also referred to as earnings or profits. I hope by now you've been convinced that your story should always include an explanation of how the company plans to improve its earnings or to sustain its growth rate over time. There are only two ways for a company to increase earnings. They can increase sales or reduce costs. Most companies work to do both of these things. The income statement can help you figure out if the company is succeeding. Click any of the items on this income statement for an explanation of it. Once you've explored the income statement, click on Increase Sales or Reduce Costs to explore those topics some more. If earnings equal revenues minus costs, then a valid way to raise earnings is to reduce costs. Reducing costs not only pushes up the earnings number, it makes a company more competitive. If two companies both produce competitive products of similar quality, then the one who can build it more cheaply has the advantage. They can choose to charge less for the product and sell more than their competitor, or can sell it for the same price and make much more money than their competitor. One way to measure cost reduction is to check out the costs listed on the income statement each quarter. But it's difficult to do so because what you really care about is how costs are changing relative to revenues. One way to measure this cost to revenues is the profit margin. This number is not shown on the income statement itself, but is calculated for you in the research section of the stock shop. To calculate the number for yourself, just divide the earnings before taxes by the net revenues. The higher the profit margin, the more money the company makes for each product it sells. Once we have the profit margin as a tool, we can evaluate how successful the company is being in reducing costs. Unless the company has raised prices significantly, if the profit margin goes up, then costs are going down relative to revenues. You can compare the profit margin of the company to the profit margin of a competitor, or to the average profit margin of the industry. When a company that's highly profitable already must depend on cost cutting to boost its profits even further, you have to be skeptical. If its profit margins are unusually high compared to the rest of the industry, there's a limit to how much additional profit it can squeeze out of the business by economizing. Ask yourself, is there a long road of margin cutting ahead, or are they already extremely efficient? Your goal is to feel as confident as possible with your story. How does the company plan to increase earnings? Sales growth is the single most important factor in growing earnings long term. So you must ask yourself how the company is going to make sales rise. The company can expand its customer base. Selling its existing products to new customers brings in new revenue. When evaluating this strategy, consider how far the company is from saturating the market for its products. If a company is already selling to 98% of its potential customers, there aren't a lot left to reach. The company can introduce new products into its existing customer base. This is the most difficult, but potentially the most rewarding strategy. If the product catches on, it can breathe new life into the company. Advantages like brand names and a good reputation come in very useful here. A company can also raise prices to increase revenues. That way, even if unit sales stay constant, revenues will still grow. Of course, the danger of raising prices is that the higher prices will drive customers to competitors or encourage new competitors to enter the market. The details of a company's plan will vary by industry and by individual company. Just make sure you understand that plan and include it in your story. Once you've built the story for your company, you have a powerful tool for judging the stock. But like any powerful instrument, you must use it wisely and carefully or you'll get burned. Use your story to pick the right time to buy a stock. I promise you that the right time to buy a stock does not occur often. When I'm following a stock, buying opportunities present themselves once or twice a year, if I'm lucky. I look for times when the potential upside is high and the potential downside is reduced. Understanding that balance is a key to successful stock investing.
You have to understand, stock picking is a risk-reward trade-off. You have to know how much you're going to lose if you're wrong and how much you're going to make if you're right. The skill is to minimize your risk and maximize your reward. You can be wrong in this business. I've been wrong quite a bit. But you can be wrong and still make money, as long as your good stocks more than offset your mistakes. I figure if I can be right 6 times out of 10, that's a good batting average.
When I pick stocks, I think of risk as a measure of my confidence in the story I've built. When I feel that my story is optimistic, solid, and well-researched, then I've got a low-risk investment. If I'm not too sure about how the story will turn out, then the risk is considerably higher. Don't try to categorize risk by other measures, like small companies are riskier than large. In the late 1970s or the early 1980s, Walmart was a lower risk investment than IBM because the Walmart story was nearly bulletproof. If a startup company sounds exciting, keep an eye on it. Perhaps a year or two later, it will be over the hump, the story will be solid, and there's a good time to consider investing. If you believe strongly in your company's story, then you shouldn't waste your time waiting for the ultimate buying opportunity. Investors who bought McDonald's in the 1970s or Home Depot in the 1980s were happy almost any time they bought the stock. Even with these great companies, during stock market corrections, the stock dipped and the story was solid, but if you held on for a reasonable amount of time, you were a very happy camper. Watch out for ridiculously high prices when a company is selling at several times its growth rate in earnings. Remember, that's what we talked about in the price earnings presentation. But in general, if a story is good, you probably want to own it. Later, if a buying opportunity comes along, the stock falls well below its growth rate, and the story hasn't changed, you can buy even more. Therefore, you can take advantage of market declines. Use the tools I've presented in this consultation to help make a judgment on your stock. If the story is sound, check the price. Use the PE ratio. Most importantly, rely on your edge. First to build your story, then to find the right times to add or reduce your position.
Focus on the company. What is it making? Where's its money coming from? What is the competition doing? Ignore all the background noise. Just keep checking that fundamental story. See if it's valid, see if it's getting better, see if it's getting worse. Know what category your stock is in and how those stocks behave. If your stock isn't behaving as you expect, then try and find out why. If the answer changes the story, then think again. Keep your story up to date. Don't check on it 3 times a day, but don't just ignore it either. And checking the price of the stock does not count. It's checking the fundamental story. Don't expect to make a ton of money overnight. The stock market does provide the highest return for long-term investments, but that's not a month or 2 months a year. If you need the money next winter, you don't have the tolerance to keep it tied up for the long term, and stocks may not be for you. Don't forget to use your edge. These are all kinds of things that you know about. Because of where you live, what you do, you have lots of edges. Use them. And finally, remember that stock picking isn't gambling, and it isn't for everyone. You have to be prepared to do some work. You have to be prepared for market declines. If you enjoy doing research, if you enjoy learning about companies, and you have the stomach for the ups and downs of the stock market, then investing can be a lot of fun. These principles of investing have worked well for me. I hope they can help you.
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it.
To start researching your stocks, just click on Research, And remember that you can come back to consult Peter at any time. Welcome to Stock Shop, where you can learn to pick stocks, research them, and follow your favorites. The consultation part of the shop is where Peter Lynch explains how he thinks about stocks and how he makes his choices. These multimedia presentations describe some of the key concepts that will help you construct your portfolio. Just select the presentation of your choice from the list on the left and click the Start button to share Peter's thoughts and experiences. The research section is where you can create a list of companies that you want to research. You can download current data on any number of stocks and get Peter's guidance on what to look for next. And you can start to compile your own story for every stock you follow. Just select a stock and click on Details to view the fundamental data about your stock. And finally, at the bottom of the screen are all the tools you'll need to explore and keep track of your discoveries in the Stock Shop. And now you can either select one of Peter's personal presentations, or if you want to get to work, go straight to research.
You can't just go out and buy a stock and hope it goes up. You have to have a reason why you think a stock will go up. You should be able to tell those reasons to someone else in just a few minutes. People who love stocks don't talk about sports. They don't talk about their dog. They talk about stories. A story is what's happening inside a company and signs that point to what's likely to happen in the future.
You ought to be able to put it down in 2 paragraphs. It could be something like earnings are turning around, a new product, somebody's gone out of business that was competing with them, they've just discovered oil, they've got new management, their balance sheet's getting better, they're getting rid of a losing division. There's lots of different elements, but that's what a story is, and that's what you rely on.
A good story is one that you could tell a 5th grader, and he or she would understand. The more complicated the story, the more likely it is to fall apart. You just need one good, simple story to buy a stock, and then follow that story.
Read through the story that I wrote for Toys R Us back in 1978. You didn't need a degree from business school to realize that this company had a great formula and had lots of room to grow. The thousands of people who shopped there knew the store was great. I did the rest of the research I needed to fill in the story and bought the stock. Building stories like this one is how I decide what companies to own and which ones to stay away from. Remember that stories unfold over time. Companies are never stagnant, so you have to stay tuned and sometimes make adjustments. It's just like playing 7-card stud poker, or perhaps 27-card stud poker. At the beginning of the game, you only know some of the cards and must place your bet accordingly. But as each new card is revealed, the game changes. You're forced to alter your betting strategy, perhaps even drop out of the game altogether. In the rest of this consultation, I'll show you how you can build stories for companies and invest more prudently in their stock. This consultation is divided into 3 sections. The assessment section helps you decide whether stocks are the right investment for you. Stock picking is not for everyone. These presentations will help you assess yourself. In the story creation area, I'll cover the basic concepts you need to create your story. You'll learn how to approach a company's story and why you have some advantages over even the most dedicated investment professionals. In the last section, we get down to brass tacks, talking about the actual elements and numbers you'll need to include in your story. Use the Start and Next Presentation buttons to move through the presentations in order, or explore on your own using the list on the left. When you're done, you'll know how to build the story, how to monitor the key elements of the story, and how to use that story to improve your understanding of when and when not to invest in a company's stock. You may find that stock picking is not right for you, at least not until you feel more comfortable with the risks of the market and the volatility of stocks. Even if this is the case, the Stock Shop can still help you become more comfortable with the stock market and researching companies. Use the Stock Shop to follow companies in a paper portfolio, a list of stocks you buy and sell only on paper. You develop your stock picking skills without taking any of the risks. Before long, you may be ready to start investing your real hard-earned cash. In the meantime, if you like to invest in stocks, your best option may be an equity mutual fund. If you want to put some of your money in the stock market, you don't have the time, you're not willing to do the effort, you don't have the stomach to do the research, equity mutual funds are a great answer.
Investing in mutual funds is also a way of making sure your investments are diversified. Mutual funds, by law, must invest in at least 20 stocks at a time, though most funds invest in far more than that. As a mutual fund investor, you are protected from the danger of 1 or 2 stocks dropping sharply in price. At most, they would only represent 5 or 10% of the fund. This would cushion the decline. Remember, the mutual funds are like any other investment. They carry real risks of losing your money, and even though they can be purchased through many banks, they are not insured by the government. Since they are made up of individual stocks, equity mutual funds are also volatile. You must do some research to evaluate and choose a mutual fund that will meet your temperament and your investment objectives.